Hey guys, Akil Stokes here, and welcome back to another episode of The Trading Edge, episode 200. It's amazing that we made it that far in such a short period of time, but I guess when you consistently do things, it adds up. If you guys are brand new, my name is Akil Stokes. I'm a professional Forex trader. I'm also a trading coach over at tier1trading.com. And this is a video that my business partner, Jason Greystone, and myself put out on a daily basis to our members. And when I get the time on the weekend, I try to share with you a YouTube version of it as well. Now, I apologize for not being here for the premiere. Typically, we do a big premiere on this on YouTube. Everyone gathers in the chat. We talk throughout the video. But I'm going to be on the road this weekend. In fact, I'm leaving in a few hours. But I trust that you guys will still have just as great as of a conversation on your own. Now, in today's video, we're going to look at a single pair, short and sweet, the euro dollar. It is an early version of the trading edge, so the markets haven't closed yet. So I don't know if the analysis is going to be the same by the time you guys see this as what it is right now. But what you want to pay attention to is the process, pay attention to the concepts, and look at this as a learning opportunity and not a signal service. Hey guys, today we're going to take a look at the euro dollar, and this trading edge is going to be a little bit different than the typical ones that I do on the weekend. Because it's a busy weekend for me, I'm actually going to be out of town both, leaving tonight, Friday and Saturday, then I got Sunday is full of meetings. I wasn't sure if I was going to have time to produce one. So what I'm doing is I'm producing this Friday morning. It's about 10:30 a.m. So there could potentially be a lot more movement in the market by the time this video gets up to you, which may throw off some of the analysis. But either way, if you guys are frequent viewers, or I guess if you guys are new to these type of videos, the point isn't to give you trading signals, right? What we do here at Tier 1 Trading isn't a signal service. These trading edge videos that we produce on a daily basis for our members aren't signal services. Rather, it's a chance to practically apply the information that you're learning to the live markets. And whether you're learning that with us through our training courses, or whether you're learning it through a book or maybe online, it's always a different story when you're looking at it in hindsight, right? Books give you perfect examples, right? I try to share with you both good examples, winners and losers during the training to kind of give you a realistic view. But the easiest way to get a point across and show how something works, whether it's a strategy or a technique, is to show a winner. However, it's a lot easier, for you guys that have done back testing, you know this firsthand. It's a lot easier to identify and see stuff in hindsight when you already know the outcome than to see it live. So this is practicing some of those concepts in the live markets before it happens, and just showing you the process that I go through when looking at a trading opportunity. Now, I'm on the daily chart of the euro dollar, and you can see that we're having a very bullish day. Currently, we're putting in a big bullish engulfing candle, that big green bar right there. And Fridays are a non-active trading day for me. I kind of handle the business development side of things on Friday and pop into one of our accountability sessions if I can. But so I haven't had a lot of chance to be in tune with the market, but I know it's been called Indictment Friday. That could have something to do with dollar weakness today. We're also in the middle of a government shutdown, so some of the data reports that would typically come out today aren't coming out. I haven't really checked on the euro side of things. I know there was an ECB press conference yesterday. There was, talk about the future there, so I don't know if that's playing a part as well. At the end of the day, it doesn't really matter. I like to know what the fundamentals are just because I'm curious. I'm in the market. I have a passion for the financial market, so it interests me, and I like being able to explain it to our members when they ask. But at the end of the day, when it comes down to trading, the only thing that matters for me is what's on the price chart. So we're going to drop down to the 240 time frame, and I want to show you what I would expect here in the euro dollar. And a lot of this is going to depend on how the day closes, if we can violate this level or not. But again, we'll take it at first hand right here. A higher high, higher close above this level, and really even a little bit higher, about 114, it's called 114 evens, would allow me to make the prediction that price action is likely to go higher. And if price action is likely to go higher, the next question I want to ask myself is, where is price action likely to go? This is the I and P part of that four-step trading process we teach called Identify, Predict, Decide, Execute, IPDE, where you want to identify what you see on the price chart. You want to take what you identify and use that to make a prediction. You then, after you make that prediction, you want to decide if I can enter or how should I go about entering, right? Decide how you want to attack it, or decide that you want to play the sideline if nothing meets your plan. And then finally, E is the execution. That's actually pulling the trigger on the trade, getting involved. So identifying a higher high, higher close here. And again, we don't have that yet, but let's kind of just assume that we're going to get a higher high, higher close there. Allows me to make the prediction that price is likely to go higher. And if price action is likely to go higher, then the question I want to ask myself is, where is price action likely to go higher to? Just to pause real quick to have a father moment. I don't know how many guys have kids or have read the book or seen the show, If You Give a Mouse a Cookie. We were watching it last night. It's like, if you give a mouse a cookie, then he's going to ask for a glass of milk, and it goes on and on and on and on. And it's funny, we were watching it, my kid loves it, and he kind of goes along with the book and reads it as well. And all that book is if-then thought process. It somehow it hit me. It's like, if you give a mouse a cookie, then this. If this, then that. And that's the same way we want to set up our trading. If price goes here, then this, right? And it's just kind of cool how trading and life kind of merge into this singular form. It's interesting. But anyway, back to the charts. The zone in which I would predict, and this is very important, right? Because we always start off with zones. I think a lot of traders think that our job is to predict like a single price point. It has to come to 115.21 exactly. And that's not the truth. The truth is, markets are often sloppy. They're going to give us zones, and then it's our job to really pick apart those zones and figure out where within that zone we're expecting price to go, where within that zone we're expecting price to reverse, and all that fun stuff. But the zone in which I would expect price action to go through is going to be right here. And you can see that if we just look at our price chart, right, in the past, look left, structure leaves clues, we can see that we have a handful of consolidation at that level, right? We have a level right here where price action found resistance. We came down, broke under it, found resistance again. Came back up, got above it, resistance at the high, support down here, right? Resistance, support, right? All throughout this zone. And again, we'll as we go on and we go to make more predictions, we'll kind of dial in on it. But this is where I would expect price action to go. Now, if we want to get a little bit more detailed, there's a few things we can do. One of the tools that I like to use is, structure is first and foremost for me. So I have structure levels that I'm looking for, and I'll show you that a little bit later. But a Fibonacci tool, right? We can take our Fibonacci retracement tool and draw out a Fibonacci from our swing high to our swing low right here. Let me just make sure I have that low. I got that wrong. Take off my VS1 levels because the big old spike is kind of messing things up. But swing high to swing low right here. And I could look for what Fibonacci levels lie within that zone. We have a 50% level and a 618. 50% is technically not a Fibonacci number, right? Fibonacci numbers are the previous number. The current number is the sum of the two previous numbers, and 50% doesn't work with that. But 50% is a psychological zone because as human beings, it's very easy for us to identify like halfway points, right? Quarters, thirds, halfway points. So 50% is a very important level. But just above that 50% level, we have a 618 as well. And the 618 is known as the golden mean as far as your Fibonacci ratios go. Now, eventually I'll be able to draw on a Fibonacci extension once we get, or if I should say, we get some type of retracement here. But because we don't have that yet, what I can do is take my Fibonacci extension tool and invert it backwards from this previous minor swing. So something like this, swing low to swing high, back down, and boom, you're going to see we have the inverse golden mean and the golden mean lining up at the same level, which is going to be the 1618 Fibonacci extension, in this case a Fibonacci inversion, and a 618 Fibonacci retracement right at that level. And this was a zone that I liked regardless. If we were to dial down kind of this bigger yellow box, the zone in which I would really predict price action to go to was going to be right in here, this area where we came down, found a little bit of structure support right there, bounced off, came down, retested that level of support, now acting as resistance before falling down. I like to call this a structure swap zone where it hits on both sides. Resistance turns to support, support returns to resistance. Now, a few ways to handle this, right? Because now we've gone on to identify what price has done, predict on what we think price is likely to do next. There's two ways to look for this. One, you can look, if you're a counter trend trader, you can look for short opportunities as price enters that zone. Or if you're a trend continuation trader, you can look for long opportunities. That means short means selling, long means buying, You can look for buying opportunities in anticipation of that zone. So what that means is that as a counter trend trader, if price action hits this level, then you're deciding, well, what do I need to happen at this level in order to get short? And you have to go to make the prediction of where do I want to take targets at, stops at, all of that fun stuff. A little bit too early to worry about that, but just so you understand the entire process. If you are looking for a buying opportunity, well, you're looking to say, okay, well, how can I get involved from this level and take targets up to this level? And this is why I think it's important to have a general knowledge of trading, because, you know, whether you want to be a counter trend or trend continuation trader, and I'm really getting away from those terms. The plan is this year to put out, I put out last year a course called the Foundation Course, which was a simplified look at reading candlesticks and the story that they give you. And it took all of the millions of things that they have out there with candlestick formations and really broke it down to 3 main concepts. And I'd like to do that on a larger scale as well, and really eliminate the idea of trend continuation and counter trend, because it's all time frame based, and really break it down to there's 3 ways to trade the market. Now there's, within those 3 categories, there are kind of smaller categories and techniques that you can use, but there's only really 3 ways, and that's going to be a fun course to do probably this summer. I don't know, whenever I get some free time. I'm too busy. But one thing we can also look for here is a head and shoulders pattern, which is a classic reversal pattern, right? We can see that price action came down. We kind of found some support down here before retesting up, looking left to those previous levels of structure. We then made a rally down on some news. We then retraced all the way back up, right? And what wouldn't be unlikely to see, and again, it's really early right now, so I don't know if this is going to happen by the time the video comes out, but it wouldn't be surprising to see some selling pressure at this level. And I should say maybe this way, the selling pressure outweighing the buying pressure. And what I mean by that is maybe people that got involved at the lows here, they're looking to liquidate their long positions, right? If you have a long position and you want to take profit, what do you have to do? You have to sell. So selling pressure coming in from those who are long. And then actual sellers, the bears, seeing this as a previous level of structure resistance, seeing this as a good place to get short as well. So sellers looking to sell. So you have buyers looking to sell, sellers looking to sell. That's when the selling pressure is going to outweigh the buying pressure, and that's what moved the market. That's essentially how the market moves. It's not more buyers than sellers. It's the pressure, because in Forex, at least, there has to be one-to-one. There can't be kind of an imbalance of that. But what wouldn't surprise me if we saw something like this, a brief retracement, right? A brief retracement. And if we travel down, this would give us what's called a head and shoulders pattern, a head and shoulders bottom, which is a classic reversal pattern. It's kind of the market gets ready the shift trend. We've been in this downward trend. The market shows that, hey, the downward trend is over. We're going to shift to a bullish trend. And a head and shoulders pattern, we can make the projection that price is likely, if, it's not valid until we break the shoulder line, or the neckline, excuse me, but we can make the projection that price is likely to go up here. So again, if we just make one more long-term projection, and I keep putting emphasis on this, it's way too early. This is why we need to be adjustable with our analysis as price goes on. But let's say that we take this initial move right here. Let's say we get a move that comes back essentially symmetrical with the previous shoulder. So right around this area, right? If we take an equal measured move, where did I just put it at? We're going to delete this. If we take an equal measured move here and attach it on there, right? This is going to be an AB equals CD pattern. If you haven't seen it already, there was a YouTube video I did earlier this year about ABCD patterns. You can go through the archives and check it out. But if we get a one-to-one measured move here, that's going to project us to have an AB equals CD pattern right up in that zone where we had the 1618 and the 618 Fibonacci extension. So again, 2 ways you can handle it. That could be more confluence if you're a counter trend trader, or if you're a trend continuation trader or a head and shoulders trader, that just gives more confluence on an area in which you should probably be looking to take targets at. So pretty cool stuff. Now, before I let you guys go, I just want to give you guys another update on how the trading year has been, and really address a few comments that I had, one on YouTube and one on Instagram. And if you followed my YouTube videos for any amount of time, you know that I am a transparent trader. I'm not like one of the guys up there that are selling you, Lamborghinis and gold chains and saying you can increase your account by 300% every week. Jason Greystone and myself do a very good job of showing you what the reality of trading looks like. And the reality of trading is sometimes it's very good, sometimes it's very bad, sometimes it's just meh, right? It just does nothing. If you guys have ever traded during the summer, that's typically how a summer session is. You just kind of drift sideways and stay afloat. But one of the comments that I got was, hey, I think it was the trader's first time watching a video, and last week's video I happened to talk about a few wins. I said, hey, I'm off to a hot start this year. You can see in the upper right-hand corner, I've got a 73% win percentage. He's like, hey, Akil, you're just like these other traders, blah, blah, blah. All you do is talk about wins. How about you share some losses? And again, historically, I'm a 55% trader. It's funny because, this guy's talking about me sharing losses. Typically, the internet makes fun of me for being so honest about what some would consider a low win percentage. I don't personally think it's a low win percentage, industry standard, right? Many of your greatest traders of all time range between 20 and 40%, just to give you some perspective. But it's not what social media typically tells you. Social media typically says 80%, 70%, so 55% looks kind of dull. And the truth is, right, I haven't really talked a lot about losers this year because I really haven't been losing. It's been a great start to the year. 11 trades taken. I've got a risk-free position on the board right now, the Aussie Canada. But I've had 8 wins and 3 losses, I believe it is. So it's been a good start. So while I'm on this hot streak, I want to share it with you. But guess what's coming? And I talk about this all the time, right? Guess what's coming? A drawdown, right? I will revert to the mean, right? Historically, I have been a 55% trader. I kind of max out at 60, I bottom out at 45. So I know where my range is. Hitting at 73%, although I would be doing backflips if it's sustainable, but it's probably not going to be realistic. I probably am going to be faced with a losing streak that's going to bring my average down. And this is why it's very important to stick with your plan, right? We get a lot of traders that they do one of two things, right? During a losing streak, they stop trading, or during a winning streak, they stop trading because they think that a losing streak is coming. The truth is, on an individual trade by trade basis, we never know what the outcome is going to be, right? Can you guys tell me what the outcome of your next trade is going to be, whether it's going to be a winner or a loser? No, you can't, because guess what? If you knew what it was going to be, if I knew it was going to be a winner, I would have my entire account bet on that trade. If I knew it was going to be a loser, I would never take it, right? We know our longer term win percentage, right? We know that we should win 6 out of every 10 trades, but we don't know how those 6 are going to come. It could be 6 in a row, then 4 losers in a row. It could be win, loss, win, loss, win, win, loss, win, win, loss. It could be back and forth like that. The key is we want to stick to our process, right? We want to trade our plan. We want to take full advantage of our hot streaks. That way, when the losing streak comes, we have a big enough cushion that it doesn't take away from our profits, right? The biggest mistake you can make, and for you guys that are on the platform, I gave you a visual look at this in yesterday's Trading Edge video, kind of with the equity curve and whatnot. But the worst thing we can do is cut ourselves short in a winning streak, and then when that losing streak comes, it sucks up all of our profit. That way, instead of the next winning streak making new equity highs, the next winning streak only takes us back to break even, and then the next losing streak sends us into the negative, and we start having an equity curve that is going from your top left to your bottom right instead of your bottom left to your top right. So it is important to understand that. And that's why when looking at stats, the biggest thing, kind of going back to that 55% win percentage, because another question I got on Instagram is, how can you be profitable being a 50% trader? Right? Do any of you guys know the answer to that question? I know I'm not here live, but I am going to premiere this so you guys can discuss it while you're watching this. But who knows the answer to that question? How can you be a 50% trader and still make profit? Some of you may be thinking it's a dumb question, but you know what? There's no such thing as a dumb question, because people ask questions to find out information that they don't know. If they get the answer, they've learned something, they've moved in a positive direction. It's not dumb, it's a positive question. But the answer is simple, right? Your wins need to outweigh your losses, and not in the number of wins, but your average win needs to be bigger than your average loss. If your average win is bigger than your average loss and you are 50%, guess what? You will make profit, right? Just do the math, right? Take 5 winners at averaging 100 pips, take 5 losers averaging 99 pips, right? So you're profitable, your risk reward ratio, or your average win versus average losses is positive by the most minimum margin, but your number is still going to be above 1. Your expectancy is still going to be positive in that case. And that's the most important thing. So wanted to address that just for you guys that are new, to kind of not only dispel some of these myths out there about traders and you got to be 80%, but just to show you that your win percentage isn't the greatest thing, right? You want to know your win percentage. You want to know your average risk reward. For me, it's 2 things. Yes, I want to win more than I lose, but I also want to keep my average win bigger than my average loss. And if I'm doing those 2 things, I know I'm going to be in a very profitable position by the end of the year, because I know I have a positive expectancy, a positive profit factor, and all I have to do is consistently execute and extract that edge from the market on a consistent basis. So I hope you guys enjoyed that video. If you did, I ask you for a few favors. 1, hit that like button. 2, share this on social media. Feel free to tag me and let me know what you thought. 3, leave a comment below. Even you trolls out there, we've been dealing with a troll situation as of late, but he watches every single video, so that's a positive. I respect that and I appreciate you despite your negative comments. Finally, if you like what you saw and you want to be in the know about when these videos are coming out, make sure you subscribe to this channel. Make sure you hit that little notification bell whistle. That way you'll know when these Trading Edge videos comes out. That's when you know when the Trading Coach podcast videos come out. Basically, anything I upload to video, you'll be in the know about. All right, so hope you guys have a fantastic weekend. Until next time, plan your trade your plan. Take care.